Hi, my name is Sara Glakas, and I'm with InvestingAnswers.com. Today, we're going to talk about some pretty important information you need before you start investing, and that is the difference between stocks, bonds, and funds. Let's start with stocks, a word you've probably heard before. A stock is simply an ownership interest in a company. So, if there is a company out there that you've always dreamed of owning, you can go into the stock market, buy one share of stock, and you're an owner. Investing in individual stocks is great for some people, but it tends to be a little bit risky. Stock prices fluctuate from day to day, and they can fluctuate by a lot. So you could buy a stock today for $100, and by tomorrow, for reasons that you might not even understand, the price could go down to $90 or lower. So, if you want to start with something a little safer, bonds may be the answer. Bonds are much safer than stocks because a bond is like an IOU. You're lending a company money, and it's promising to pay you back plus interest. That promise, which is legally binding, makes bonds a lot safer than stocks. But for most people, the most important investment term to understand is funds. If you have only one investment, it will most likely be a fund. A fund is simply a collection of stocks, or a collection of bonds, or even a collection of stocks and bonds together. Instead of buying just one stock or one bond, you can buy a fund that holds a basket of many different stocks or many different bonds. It's the ultimate in one-stop shopping. There are three main types of funds: index funds, mutual funds, and exchange-traded funds. An index fund tracks an index like the S&P 500. The index fund simply buys all the stocks that make up the index. For example, an S&P 500 index fund will buy all 500 stocks that are in the S&P 500. If the S&P 500 index goes up, the S&P 500 index fund will go up too. Mutual funds usually try to do even better than an index fund. A mutual fund manager tries to buy stocks that will outperform and sell stocks that will underperform. If the fund manager makes the right choices, your mutual fund will do better than an index fund. But if the fund manager makes the wrong choices, your fund will do worse. That's the risk you take when you buy an actively managed mutual fund. Finally, there are special funds called ETFs, which stands for exchange-traded funds. ETFs are very similar to mutual funds and index funds, but they trade like stocks and they have slightly different tax rules. Ask your tax professional for more information. Thanks for spending time with us at Investing Answers. For more investing definitions, check out our financial dictionary at InvestingAnswers.com.